New York Community is largely an apartment lender in the New York City area, rent-controlled, rent-stabilized apartments. So those buildings are affected by recent New York rent rules that cap how much you can charge to your tenants. On top of that, you have higher interest rates, so it squeezes the landlords, and there's a lot of refinancing risk ahead. So they posted a big loss there in the fourth quarter, and there's questions ahead. They have about 4% of their loans in office exposure, so that's a touch higher than the median in our coverage universe. So there are some credit quality concerns ahead, and they built their reserves pretty much in line with peers in the fourth quarter to address that.
I'm looking at the Spider S&P Regional Banking ETF. KRE is the ticker. It's off 3.45% today on this news, presumably. How much is this a New York Community Bank problem versus maybe a wider regional bank problem?
Yeah, so New York Community is really the last of the larger regional banks to report their fourth quarter earnings. And pretty much across the board of their larger peers, everybody was actually pretty sanguine about 2024 credit quality. So this seems more of a New York Community specific issue of needing to shore up their balance sheet and facing a blip on their credit quality that they need to instill some more confidence in the market ahead.
Do you think someone's going to ask a question to Powell about this today? Or do the reporters already have their questions planned out?
No, that would be a good one because it's certainly topical.
Yeah, I mean, what would the Fed, how would you expect Jerome Powell to react to a question on, like, does this signal more weakness?
Yeah, I'd assume he would say something to the effect that the banking industry is resilient and you've seen stability in deposits and strong credit quality for the industry. And New York Community specifically had an issue with the fourth quarter. But I would say overall, the banking sector has been really strong and resilient ever since that March and April turmoil, and stabilized deposits, increased their capital. The larger ones are shoring up capital and liquidity ahead of tougher rules. So it makes for a much sound and safer system.
So where are we? Like, how would you characterize the industry in terms of getting to where it needs to be in terms of their balance sheets, their credit quality? Because it was such a shock, I guess, a year ago when we had some of those regional banks kind of hit.
Yeah. So ever since that March and April timeframe, a lot of the banks have been defensive in nature. They've pulled back on lending. They've exited some loan portfolios, exited relationships that weren't profitable. Just been very conservative with how they lend and how they operate. So they've had 3 quarters of conservatism that they've built up their reserves. So they've done a very good job of addressing some of these issues. And aside from what's happening today with New York Community, I think the market's been pretty receptive to the actions that the bank management teams have done over the course of the past 3 quarters.
And where are we just in terms of, kind of repairing the earnings capability of these banks? Because that's kind of what you told us all along, that this was going to be more of a challenge from the earnings power of these regional banks as they deal with higher rates and so on and so forth.
So we're getting towards sort of the end of the weakness in the top line. The pause in rate hikes last year has helped shore up the pace of deposit repricing. So the margins, the net interest margins for the banks are starting to stabilize a bit, and we're hoping that once rate cuts start materializing, the industry in the back half of the year expecting a resurgence in lending and improving top line performance and improving earnings. But really all of this is predicated on if we get the rate cuts and if we get a soft landing.
How are investors supposed to be thinking about the dividend cut for New York Community Bank, slashing the payout to shareholders to 5 cents from an expected 17 cents?
Yes, so that's an interesting thing because New York Community has historically prided themselves on having a strong dividend, had a lot of insider ownership of the bank, and so the dividend was very key to them and to their shareholders. They do skew a little bit historically to a retail investor base as well. So this was a decision that the CEO said they didn't take lightly, and it was more of another step to build capital ahead of the tougher regulations. They're pointing to a CET1 ratio of 10% versus the current 9.2%. So earnings generation and the slashing of the dividend could help them get there by the end of next year.